You've probably noticed a lot of talk, tweets, or YouTube videos recently about the Schwab US Dividend Equity ETF, that's ticker symbol SCHD. Most, if not all, of these reviews calling it the holy grail of dividend growth investing, the GOAT, if you will. Today, I would like to take you through a deep dive of that popular dividend ETF from Schwab, as well as look at its not nearly as hyped or discussed international counterpart, ticker SCHY. Both of those funds operate in the same manner, so if you like the methodology SCHD follows, then the international complement of SCHY could add some additional diversification to your portfolio. I'll also cover how to create additional yield on SCHD in the form of cash secured puts and covered calls, including advantageous times to initiate those option strategies from a technical perspective. I'll also briefly demystify dividends a little bit since I think they can be misunderstood. We'll look at the math versus the psychology surrounding dividends. If you're new here, welcome. My name is Matt and this is my channel Trading Your Job. I enjoy making content on most finance topics, and this ETF deep dive is an example. Today's video is sponsored by the subscribe button. It's free to subscribe and it would really help my channel grow. SCHD began in October of 2011 and is a very low-cost ETF with the expense ratio clocking in at 0.06%. That means for every $10,000 you invest, the expenses the fund charges you is $6 for a year. They don't bill you or anything. Those expenses are incorporated into the share price throughout the year, but they are still very real costs. That's why it's important to pay attention to expense ratios of your investments, as high expense ratios can really eat away at your real returns over long time periods. SCHD has 103 holdings currently. Its goal is to track the Dow Jones US Dividend 100 Index. The current SEC yield is 3.44%, which many dividend investors find attractive because it is getting close to that 4% distribution target many calculate their retirement needs from. More about the powerful psychological aspect of that later. The Dow Jones US 100 Dividend Index is not directly investable. It's a methodology of selecting the companies that make it into the index. This index drives what Schwab holds in SCHD though. SCHD has to invest at least 90% of the assets inside of it from the holdings in this index, and no single holding can make up more than 4% of SCHD. So what does it take to get into the Dividend 100 Index? The three major criteria are dividend payment consistency, company size, and stock liquidity. They accomplish this by looking for 10 consecutive years of dividend payments, a minimum market capitalization of $500 million, and liquidity as measured by trading volume of over $2 million daily. The Dow Jones Dividend 100 Index launched in August of 2011, and as I mentioned, it's not directly tradable. Schwab created SCHD a couple months later to mostly track that index. Here is the index methodology in a bit more detail. Notable is the fundamental selection portion. The stocks are ranked by composite score of cash flow to total debt ratio, their return on equity, dividend yield, and their 5-year dividend growth rate. The top 100 are the constituents of the index. If a company cancels or suspends their dividend, the index will remove them from that index, and therefore SCHD would likely have to remove it as well. How does the methodology perform? Well, the total return pictured here seems to suggest that it works very well. When selecting a fund or ETF to invest in, yield is not the only thing you want to consider. In some cases, the fund can have a very high yield, but a negative total return. A high yield with a negative real total return is definitely called a yield or dividend trap. So SCHD has a positive total return history over long time periods, which is important because you want to make sure that your pot of assets has the potential to keep growing. That's not to say SCHD will not experience negative years, definitely will, but it does mean that the yield it produces is not eating away at the principal like some ETFs. You can see on the returns chart that the Dividend 100 Index experienced higher total return than the US Broad Stock Market Index. It had lower volatility, lower maximum drawdown, and higher risk-adjusted return. The same was also true on the international side of things for SCHY. There is no guarantee this will continue to be the case, but that's been the result over a 20-year time period. And why is that important to many people? Because the psychological aspect of lower volatility, higher predictability, solid dividend yield, and a good total return. That 0.06 expense ratio is very evident when you compare the returns of the non-tradable index with the returns of SCHD market price. You can see that the difference in the market price and the Dividend 100 Index in terms of their performance is that 0.06% cost. Over longer time periods, the ETF will also experience index track error, which is why the difference is a bit higher for the longer term than just the expense ratio. Not doling out tax advice, definitely can't know your specific situation, but a reminder that taxes should be a consideration with any investment. The investment location, meaning what type of account it's in, can be as important as the allocation. It's usually prudent to hold higher yielding assets in a tax advantaged account and tax efficient, lower yielding growth oriented investments in a taxable account. Not all dividends are created equal either. Some are qualified, others are non-qualified. But that's a discussion for another day. Just know that where you hold your investments can create tax drag, reducing your overall return and increasing your annual tax bill unnecessarily. SCHD pays dividends quarterly, so those payments arrive in March, June, September, and December. I think that there is a belief that dividends have some sort of mystical, magical, mathematical power, but unfortunately that is a misconception. When a company or ETF pays a dividend, it goes through a couple stages that you can see outlined here. First, there is a dividend declared called the declaration date. The declaration date states how much the dividend will be, when the stock or ETF will go ex-dividend, the record date, and the payable date. On the ex-dividend date, the price per share is adjusted down by the exact amount of the dividend. This is often hard to see since the stock and ETF prices fluctuate in real time during the day anyway, but that's what happens. The reason this happens is because people that buy the stock on that day are not entitled to the dividend, so the reduction in share price on the ex-dividend date makes it equal for them to be buying it at a lower price. The record date is what is used for recording the owner of record of the shares, and those holders also receive voting rights. The payable date is when the owner of record actually receives the dividend. I've seen a lot of confusion about dividends, that they are magical, and from a mathematical standpoint, that is just not true. However, psychologically, I think that they are extremely powerful. Investing and finance are not just math. There is definitely a human psychological component that can hurt or help us. I think that the psychological aspect really lends itself to lightening the mental load. There is only so much capacity in our brains in terms of decision making. Retirement or financial independence planning can be extremely overwhelming. It can also be overwhelming to choose an advisor. If you are mostly investing in growth assets and are looking for a specific retirement number, it can be difficult or pressuring to decide what to sell and buy each year in retirement, especially as you age if you do not know how to turn that into cash flow yourself. So you go from a steady paycheck that you've budgeted for to having to create your own income stream. It can definitely be daunting. Dividend investing's allure is that it breaks planning down more to a monthly or quarterly cash flow for you. It transfers some of that mental load from a big retirement number to monthly cash flow, which is more consistent. Since dividend investors tend to do this over long time periods when they're building up their projected annual dividend income, they also learn about the fluctuations and how much to build into the upside or downside of dividends each month. So there's kind of a learned buffer along the way. Even though dividends are not mathematically different than selling a small portion of your holdings every month, you don't have to take any action regarding creating that income stream. After you buy the dividend stock or ETF, it's kind of decided for you what's going to happen. You can choose to reinvest the dividends while you're in the accumulation stage, or distribute the income to your bank account when you're in the distribution stage. That burden of deciding what to buy or when to sell something to create income to go to your bank account is now reduced from a total return perspective to more of a cash flow perspective. The downside would be if the individual companies you invest in suddenly change their dividend payout or reduce it, and you are counting on that income. But you can diversify away some of this risk with dividend ETFs instead of buying individual stocks with specific company risk. You can also create additional income in the form of premiums by selling covered calls on your shares or selling cash secured puts on future shares at a lower price. The types of accounts that you save in for retirement also matter. Your workplace retirement plan likely does not offer the same breadth of investing options as an IRA. You may only be able to do a strategy like dividend investing outside of your workplace plan. There is definitely significant value in contributing at least the match in your workplace plan. That is free money, 100% guaranteed match. You should also try and find the lowest cost index options in that plan. History shows that the surest path to wealth is what you can control. That is your asset allocation and your costs, like your expense ratio. Your workplace plan will likely focus on growth, and bonds could be the income-focused asset class in that account if you're looking for something with yield. Dividend ETFs might have a place in your other tax advantage space. This could be as a strategy diversification and also as psychological diversification so that you can stay the course when there are big fluctuations in your other accounts. Just touching quickly on the international version, ticker SCHY, has a slightly higher expense ratio of 0.14%. That's typical for international holdings. Does also have a slightly higher SEC yield and some more holdings, about 134. It's also a large value morning style category just in the foreign version of that. You can see the breakdown of countries here. It helps to diversify some risks away from the US market and US dollar. First, I'd like to look at how much SCHD yields currently. It currently pays an average dividend somewhere in the neighborhood of 60 cents a quarter, so we're just going to use that. 60 cents, and in one account there's 450 shares here pictured, so the total value of that around $35,000. The quarterly dividend on this amount of shares, so 450 times 0.60, is $270. and then that's quarterly, so you divide it by 3 to get $90 a month on average. You can more than double your yield by selling out of the money covered calls. They're considered covered calls because you actually own the shares that you're selling the options on. So 3 contracts in this case that I've sold are 300 shares worth, so I still have 150 shares that are not covered. I received $108 in premiums for selling the 3 contracts. They're expiring in about a month in April, and you can rinse and repeat when they expired. If you do this in a tax advantaged account, it doesn't matter tax-wise if your shares get assigned, you just buy them again. On the other side of things here, if you have cash that's uninvested, before taking any risk on that money, make sure that you are going to earn more than the current yield on your money market or your sweep account and your brokerage account. So you can earn premium on your cash to buy SCHD at a lower price in the future. For example, if you wanted to sell a cash secured put at $71 for April 21st, you would receive about $55 for doing that. The delta over there of 22 tells you there's about a 22% chance based on the implied volatility that would happen. So you'd get to keep your $55 on your $7,100 you had to lock up for that time period. If it got assigned, you'd have to buy 100 shares at $71. If it doesn't get assigned, though, you can just do this again, and you can keep doing this over and over. As far as when would be a good time to sell a covered call or a good time to sell a cash secured put, I look for extremes. This is a 2-bar a day chart of SCHD. I look for 2 things converging. I look for hitting a Bollinger Band and the channel commodity index being overextended to the upside. So in this case, like probably a pretty good day to sell a covered call up here, probably a covered call, good day to sell a covered call here, probably a good day to sell a covered call here. On the flip side, for cash secured puts, you want to wait until the price is hitting the lower Bollinger Band and it's considered oversold. So on the channel commodity index, oversold is down below the line. I'd wait until a day like this or a day like yesterday. We're getting down to the lower Bollinger Band and it's oversold. The reason that you wait for those extremes in either direction is because the premiums increase when there's volatility like that. You want to reduce the chance that you're going to get assigned on those shares because your goal is really just to collect the premium to increase your yield. Well, I think we covered a lot in that 12 minutes. If you have any follow-up questions, please leave a comment or send me an email, tradingyourjob@gmail.com. And if you enjoy content like this, please subscribe for future videos. Thanks so much. See you next time.